My name is Phil Burpo. I'm a relationship manager at Hanscom Federal Credit Union, and we're very happy that everybody can join us today for investment, property ownership, and financing. It's a very exciting topic. It's a very exciting thing to be planning for. But as you're going to find out today, there's a lot involved in getting your thinking and your planning together ahead of doing that. So you're taking a great first step today. Our speaker today is Phil Purcell. He's our Vice President of Commercial Lending. Phil, I give him a hard time. He's been doing this for quite a while. I think he's seen everything about everything that's associated with investment property ownership, and I've never heard him stumped on a question. But fortunately, joining us also today is Michelle Sapienza, and she's our Business Development Officer. She's also a commercial lender. So if Phil gets stuck on something, Michelle, you're going to have to step in and help him out.
I'll try.
They work together, and they're a great team, and you'll have both their contact information at the end. We do encourage questions. The presentation lasts 30 or so minutes, and there's plenty of time for a Q&A. Just ask that you put those questions into the chat, please. And myself, Maria Porto, or Helder Raposo from the credit union will help work those in to the conversation. I think that's all I got. So let's get right into it. You got a lot of information coming at you today. Phil, welcome, and it's all yours.
All right, thank you. So everybody, welcome to Investment Property Ownership Financing. It's definitely a thing that we enjoy doing, and we enjoy having people do well with it. Right now, I'm trying to get my screen to fix itself. Michelle, you can go to the next slide.
We're seeing the next slide, Phil. Contact info.
All right. My screen, of course, is doing circles, but I know the next slide has, I'm going to do from my version as I knew it was going to happen, but that's okay. So this is the contact information to whoever asked that first question. My contact information is right there. Philip Purcell, VP Commercial Lending. In addition, you have Michelle Sapienza, who is the Business Development Officer. She's actually now a Commercial Loan Officer. So we have to update that slide, but it still encompasses the same activities. The next slide. So the first part of investment property financing. Some of you may have properties, you may not have properties, you may just be thinking about it. But the first thing you want to do is basically figure out, choose a property. How do you choose a property? So you're thinking about investment property ownership. What kind of properties are you thinking about buying? You could be looking at a single family. You could be looking at a multifamily, which can be anything from a 1 to 4 family or bigger. You could be looking at a mixed use, which is classified as a residential upstairs, but a retail store or a retail space on the downstairs. Could be an office, could be a store, could be whatever, but that's a mixed use property. And then a commercial property, strictly being a commercial building that a business would rent from you, et cetera. So those are all classifications of investment property. So you're not the owner. You could be an owner-occupied property, but these are just classifications. You could also have like a strip mall. That would also be included in that. When you're looking at these properties, trying to determine what's the best form of ownership. One of the things you'll hear throughout this presentation is having trusted advisors by way of a lawyer, an accountant, a broker, people that are knowledgeable. All of those things are what I classify as people that can help you to create the best structures for yourself. So then ownership, you can own things individually. You can own them in what's called an LLC. You could have it in a trust, a partnership, or a sub-S corp. There's lots of different forms, and they all have different implications as far as tax reporting and things like that. So you'd want those trusted professionals to help you to figure out what is the best scenario for you. So that's that. Go to the next slide. Where and how to look for a property. Finding a broker to team up with is often a great way. You say, okay, this is the type of properties I'd like to be looking for. The broker goes out and looks for those properties for you. You can surf the web, just looking online, trying to look at places like loopnet.com. You can drive around looking for sale signs. You can look in neighborhoods that you live near or around, or where you want to buy a property, and you can look around for the for sale signs and approach those people specifically. investment groups. Actually, right now, Billy, do you see me still? Because my screen is black.
I don't see you, Phil, just so you know. We hear you fine and I'm handling the slides, but you're not present on your little square.
So just try to check, because I know I'm connected. So let me just try to click the come in button, if it will let me. It's not right now. That's all right.
We hear you
all right,
fine,
so we had
Phil. So.
Okay, so we'll just keep going with my voice. Real estate investment groups, I mentioned that real estate investment groups are in almost all areas out there, and they're interested people that either own properties, want to own properties, or are professionals within the real estate area. They meet, they have breakfasts or lunches or dinners, whatever, and it's basically a great resource because you can find properties without a broker. You can go there, you can be sitting next to a person, they might be elderly, saying, I just want to get out of owning property. You become their best friend, and then you can start buying properties from them from now to the end of time. Those are very good resources. You can also just find a real estate investor, somebody else that you come upon in passing that's looking to divest. They just want out. They just want to sell their stuff, and you can just keep buying 1 property, 2 properties a year, and just get in friendly with them. They know you're going to take care of the property the way you should, the way they want their tenants taken care of, et cetera. So that is a great resource. And then there's always other ways of finding properties. Who knows what they may be, but there are other options as well. But these are just a few examples of how you can find a property. One of the most important things to look at when you're looking at a property is determining what's the cash flow. Figuring out, does this property would it make you money? Is it worth your time and effort or not? So that's something you'd want to start out with. So when you're looking at a property, if you can get a copy of a Schedule E, which is the tax return Schedule E, that would show the current property's rental income, expenses, profitability, et cetera. That's something that would tell you what the property is making. You want to get that for multiple years. So if you're looking at somebody's property, they are willing to give you the Schedule E, you get that. If they're not willing to give you the Schedule E, or if it's not available, you start gathering information. How much would an average insurance cost for that property? What would be the normal utilities for that type of a property? And you can have an investment property. We have a cash flow sheet, and basically you fill it all out. Rental income at the top, put in a vacancy, a management fee, repairs, maintenance, all the expenses. You'll come up with what is the dollar amount at the bottom that you're going to make for cash out of that property. At that point, you take that cash number, and then you figure out how much money you're going to borrow against this property, and it would help you to figure out what is your cash flow debt service capacity going to be for that property. So what you're looking for is, does the cash flow that's going to generate cover the debt that's going to be on the property? We're going to get into a little bit more of that now on what to look at specifically. So just as an example, you could have a property with rental income, totally hypothetical. All these numbers are just what ifs. You would have, let's say, $55,000 in rental income. Then you have the 10% vacancy deducted. And I'm assuming, not being able to see the screen, Michelle, you have them staring at the income property cash flow sheet.
You are all set.
Okay, perfect. So you take out a vacancy, and then you have just what would be classified as an effective gross income. In this case, $49,500. You then would have operating expenses, all of those things that I mentioned that you would be trying to have determined, insurance, et cetera, all of those various fees. You would try to figure those out. In this case, we just used the hypothetical $25,000. So in this case, the cash flow generated by the property would be approximately $24,500, which is telling you how much you would have extra cash available to you for that property. Pardon my diversion while I just get myself back. I'm trying to get back onto the screen from Billy's original email.
Let me just work in a question real quick for you, Phil.
Yeah.
A question came in that would you be able to share the cash flow sheet? Do we have?
Yep, we can.
Okay.
We don't have it in the solicitation, but we certainly could. And basically, it is very similar to a Schedule E that you would see on your taxes. And it basically is just an Excel spreadsheet that just you put in all those numbers, it'll spit out the calculations, and then you determine how much you're going to actually have for debt service. You'd put in that number. It will then tell you what the debt service coverage will be, which is going to be on the next slide that we're about to do. It'll make a little bit more sense. But yes, when we have conversations, we would be able to share that sheet with you. When we give you my business loan application, it's part of the application. We have you fill it in for the hypothetical for a property that you're actually looking at. So you would put in all that information, and you can use it just as a hypothetical. I have people using that on a curbside so that they would actually be using that to do a quick analysis of the property to see if it makes sense. So in the previous slide, we came up with $24,500 of cash flow. So you'd have that number to start. And then in this case, we said, okay, what would be the debt service payment associated with this conceptual loan? And in this case, we just threw a hypothetical $1,512 a month, came out to $18,000 of a principal and interest payment. That number, cash excess, means this property would make you, after debt service, approximately $6,300. So that would be your extra cash you would be making into your pocket. And then in this case, the debt service coverage ratio, which is the total cash the property generates, which was the 24.5, because that's the cash that's available to pay the debt service. That number divided by the debt service number is 1.35 times. That is a good return it's a good starting return on the property. You don't want to be the property being less than that per se. Like our normal requirement is 1.2 times coverage because we want the property to be making money for you. So at least 1.2 times coverage for the property is what we look for. And then in this case, it's 1.35. So this property covers its debt service coverage adequately, and it's also making you about $6,000 in your pocket. The higher the debt service coverage ratio is, so if that number was 1.6, 1.8, that would mean that the excess cash you're pocketing is going to be higher, and that's a good thing. So the higher the debt service coverage ratio is, the better the property is working for you. And that's where the cash flow sheet that we can share, if it's requested, is basically you can sit on a curbside, put in all the information, look at the numbers and say, okay, at the end of the day, this property from a debt service coverage ratio is going to cover 1.6 times. All right, I'm gonna make an offer on the property. If the debt service coverage was, let's say, 0.6, 0.7, you wouldn't necessarily want to throw the offer at them because the property is not generating sufficient cash based upon the price to make that product that actually work. But that also opens up a conversation. Maybe the property is overpriced. That's something you would then look at that and say, okay, at that price it won't work. At this price it would work. So you could go back and say, hey, it's not worth 500,000. I'll offer you 400 or some other alternating number, and that would be based upon what it's cash flowing. But there can be other reasons why it's not cash flowing. It could be a property that's been rented to family members at a significantly below market price for 20 years, and they have no intention of raising that price because everything just works for them at the time. But in the market, it's worth more money as a rental entity. So let's say they're getting $600 a month, but it's really should be $1,200 to $1,500. You can still look at that property and get it financed. You would just end up buying the property and having to raise the rents to get it to what's called market rents. So just because these things show certain things doesn't mean there's not a subsequent conversation that can be had to say, hey, this is what it looks like today. So I make you fill out a rent roll to show me today's numbers. And then we say, okay, but that's not commensurate to the market. Then we have another rent roll we'd have you fill out for the market price. And then we say, wow, at that market price, this property would work. So as long as you can cover the debt service on the property in the short term, you can renovate, you can rent, increase the rents as the unit gets emptied out, et cetera. And then the property would come up and be what's sort of classified as stabilized, meaning it's actually where it should be and is a stable asset at that point. So that's just, this creates a lot of conversations. If you read online, we have an ebook that's out there about if you're interested in doing investment properties. A lot of the times, my answer is it depends, because every property is different. Every situation is different. There can be different nuances to each one. So everyone's a conversation. People ask us for like a pre-approval letter. We don't do them on commercial because every property is different. You can't really just say they're good for $200,000 and to borrow money because the property may not support it. So that's just something to think about. As far as the info required for a loan request, basically we have a business loan application that we would provide for you. In that application, it's going to have a personal financial statement. It's gonna, and that basically is a snapshot of your personal financial status, your assets, your liabilities, et cetera, your income. Then there's a debt summary sheet, which just shows all of the debts you currently have outstanding, the liabilities that are out there. We have the environmental questionnaire, which is a questionnaire that just says, is the property, does it have any environmental issues? Are there underground tanks? Are there any other issues that are associated with it? And it basically uses, I'm just still trying to log on. It uses the information about the property to determine for us how much do we want to do for more research, to do more background check on that. There are computer checks on environmentals. There may be no requirement for anything. One thing that's big in an investment property is lead paint. So lead paint is an issue that you want to make sure if a property has not been de-leaded, you want to understand the ramifications of that. Because if a child can get into that house and can gnaw on a windowsill or anything else that's out there, they can get lead poisoning and you're responsible. So lead paint is a conversation that comes up with investment properties. The Form 4506C just verifies for us the tax returns you've given us are in fact valid and legitimate. In my 9 years at Hanscom, I think I've had 2 or 3 that have not had taxes tie in to the taxes that we were handed. But in general, it's just verification. What you file with the IRS is what you handed to us. A rent roll, as I mentioned before, it can be a rent roll of how it is today, which it might be all at market rents, and that's fine. If it's not, you give me one that shows me the rents today and another one that shows me the rents that would be at market. Current summary of other real estate owns, that's basically a chart that shows us what are the properties do you own, how do they perform financially, do they make money, are they losing money, so we can take that all into account in the underwriting. And then we ask for 2 or 3 years of complete personal and business real estate taxes, including any schedules. And if there's any business entities that are not fully reflected, meaning there's like a K1 or something that flows to your personal return, we'd ask for that as well, just so we can understand the entire picture. So as far as the next one, Michelle, teaming up with a real estate attorney, push, I don't know if you push the button, Michelle, am I not seeing it, but it's still there? Okay, nope, the other way, there you go. All right, so teaming up with a real estate attorney to do a purchase and sale, you want to make sure that if you do make an offer on a property and it's something you're moving forward on, you get a purchase and sale in place. Purchase and sale should be looked at by that attorney and make sure it has certain nuances in it. You always want to make it subject. Typically, I have some borrowers that they are good enough to inspect the property. They know whether there's good and bad, so they'll do it without an inspection, but most normal people would have an inspection done where the inspector would go through, look, notice, and define, find any issues, deficiencies in the property, the roof, the heating system, lead paint, water damage, anything like that. It's a great out. If they find a lot of bad problems, it's a great way to get out of the purchase and sale. I had somebody that I never would have thought about it, but it was a brick building, which of all things, a brick building had a termite problem. And the termite problem, I never would have said, but the inspector found it. It was on the inside of the building because it had a wood inside the foundation, but it was all contaminated with the termites. He ended up walking away from that property because of that, and he was saved by the inspection. Lead paint, as I mentioned earlier, is a factor with these properties, or can be a factor. Lead paint certificates, if you get it, is fantastic, depending upon the age of the property, when it was built, etc. The old buildings often had issues, whether it's lead paint and or asbestos. The newer buildings are not as bad, but if somebody's redone a property, hopefully they've got a lead paint certificate. These properties can show up on databases with the state, which when we do the underwriting, we would find that. They do a quick look at that database, and if it shows up, they may flag it as a potential question, because if they found a problem, was it remediated or not? But something to understand in lead paint, beware of it, because just as a hypothetical, you could spend $10,000 to $15,000 to remediate 1,000 square feet of lead paint problem. So you want to make sure you go into it with your eyes open to make sure, because not only does it cost a fortune to remediate, it's also dangerous, and you carry a liability for any lead paint poisoning. So that's something to think about. And then the other thing looking at is, are the real estate taxes current? When you go to close the loan, the lawyers will get all of the real estate taxes paid up and current, but you want to know if there is a huge tax lien on the property, that can be a major issue. Same thing with like water and sewer liens. And then a septic, if there's a septic system, you need to make sure it's going to pass the Title V, which means they test the septic to make sure it doesn't have issues. And if it's tied into the sewer, that's not required for a Title V. But if it has a separate septic system, that can be a problem, because that could be a $45,000 problem. It could be 10,000, 5,000, who knows? But that's, the Title V will tell you what the issues potentially could be. When you go to get the property valued, we have an appraisal requirement where we would engage the appraisal. You would not do it yourself. If you engage the appraisal yourself, and that's on the next slide, Michelle, I don't know if you already pushed the button.
I did.
There
It
you
just, it's a delay.
Okay. Yeah, mine's probably delayed. I apologize for that. So the appraisal, you would not engage the appraisal. We have to do it. We have to utilize a third party, disassociated party to do it, so there's no conflict of interest. If you engage the appraisal yourself and say, here's the appraisal, Mr. Banker, it's worth $900,000. I said, that's fantastic. The $700 or the $3,000 you just spent, wasted because I can't use it. So just be aware that don't get an appraisal before we do it. We would engage it. And we usually do that either if there's a time sensitive issue, we can engage it before we have it approved, as long as we think all the numbers make sense. We would just say, okay, it's a quote, $2,000, $3,000, $700, whatever the dollar is for the appraisal. We would ask for that money up front. You pay it. We engage it. We can have the appraisal being done earlier than the underwriting is finished. And one thing right now we're in sort of a bizarre time where the appraisers are taking a lot longer than they used to. And periodically their prices are insane. It's like a mini monopoly right now. Some are better than others. So if you have a time constraint, you want to be thinking about that. And we would mention that to you up front. If you don't, that's fine. But we get quotes. We usually get 3 or 4 quotes, and then we'll come back to you with what we feel is the best quote, time frame wise and cost wise. And then you decide to do it. You approve us to engage it. We engage it. And when we finance stuff, it is based upon the lesser of cost or the appraised fair market value. So if you are buying it for $300,000 and the market is $400,000, I'm not going to finance the $400,000 because you're only paying $300,000. And that's just how it works. It's the lesser of the cost or the appraised fair market value. And that's how we typically do it. And then we do a maximum loan to value. In our case, 80% is a typical finance of a property. If you are getting cash out, we're more into the 70 to 75% loan to value for a cash out, because at this point, the equity that people have realized in properties is a lot of what I would call phantom equity. So a year, 2 years ago, you bought the property. Today, it's worth a lot more money. That may be real, that may not be real, because the market could have an adjustment. So we're looking at more of a 70 to 75% loan to value for those cash out concepts. If it's a straight purchase, we're typically saying the market is realistic, so we're going for the 80% for just regular purchase, because it's not with cash out. Typical loan structure for us, we try to keep it very simple. I call it cookie cutter, black and white, which is, I think it works well. We do a 15-year note, so that's the term of the note is 15 years. We do the repayment is based upon a 25-year amortization. So the loan payment itself is based upon 25 years, but the note itself is written for 15. So there will be a balloon at the end of 15. We can fix the interest rate for either 5, 7, or 10 years. And then at that point, right now, we've had 10 years fixed, takes away a lot of the interest rate risk. So if you were at 5 years fixed today, let's say it was 4.375 as a hypothetical, and then 10 years fixed was, let's say, 4.75. That little bit of difference to have 5 years of interest rate risk taken away can be very advantageous. We have a lot of people that appreciate the 10 years. We are one that does not have a prepayment penalty. So the 10 years fixed right now, I think, is a great option for people, but you could do a 5 or a 7, depends upon what your goal is. If you were going to sell the property quick, 5 years might be all you were looking for. But if you're going to hold the property, 10 years can be a better thing, and it would be fixed for the 10. Then it'll be refixed for the final 5 of that 15-year note. Then it would mature. Any owner of the entity that owns more than 20% is going to be a personal guarantor. We're going to take a first mortgage and assignment of leases and rents on the property being financed. So hypothetically, if this was an LLC, the LLC would borrow the money, and then if Joe Jones is 100% owner, they would be a guarantor on the loan. If there were multiple guarantors, they'd be on that as well. The minimum global debt service, as I mentioned before, 1.2 times is our minimum that we like to see in a property. We do the approval based upon global, but we like the property to be itself at 1.2. but there could be a circumstance where the property is only, let's say at 1 times coverage or 1.1. We then give you credit for your other personal income to make up the difference. But in the perfect world, we'd like the property to cash flow 1.2 times. So that's that. As far as reference sites are concerned, places you can go just
Phil.
to come up with some other.
I'm just gonna stop for a second because there's some questions that have come up that apply to what you're talking about in the chat.
Okay.
So David Kiernan had asked, what is the debt service coverage ratio the lender is looking for? David, I think that Phil has answered that for you, 1.2. Please let us know if you want more information in the chat. The next question is, what is the typical net worth of the first-time real estate investment property owner? In other words, how much money does the first-time investor need to bring to the table? And what are some ways first-timers can either raise or share in the necessary equity?
All right. So I'm reading the chat as well. So the question about the net worth. An investment property financing is not kind of like a franchise. A franchise has, you have to have a minimum net worth of X dollars in order to even play the game in a franchise. That
Right.
does not become a factor in investment property financing. But what I would say is go to our website and download the ebook, because one of the things I talk about there is you're going to have, as I just mentioned, the 80% maximum loan to value for the property. So you're going to have 20% of equity in the property. So you're going to have to put 20% down on whatever property you purchase. So that's one piece of money that you're going to have. In addition, you're going to have whatever closing costs are associated with the property. And that means the closing costs with the attorney, the appraisal costs. We charge a 1% origination fee. So whatever the loan amount is, we charge a 1% origination fee. So you'd need that money. So hypothetically, when you go to close, you're going to need extra money for the closing costs. That's one. So you've got the 20% down on the property, closing costs, appraisal costs, et cetera, for that piece. But then I also call what's called a hiccup factor, which is you purchase the property. I don't want you closing the loan and having $0 in your account, because if you buy the property, sudden day one, the heating system goes down. That could be a very expensive thing to fix. The roof could leak. Who knows what else could go wrong? So what we usually look to do, not the same way as residential does, where they have specific numbers and ratios and all that to have as resources for backups, for reserves. I like to talk through that and say, okay, if you're going to buy the property, I want to make sure you have some extra money just in case for the hiccups, to make sure, because it won't do either of us any good for you to buy the property, stare at it, need a heating system. Now you can't even rent it. You have to close it and you lose it. We don't like doing that. So we try to make sure you have extra stuff just in case. And then as far as, I think David asked a question, do you need an appraisal for under 500? We require appraisals typically on all of them, unless the loan to value is a certain circumstance that it's insane. Let's say it was a $400,000 loan and the property is worth $800,000 to $1 million. There are potentially, and I'm not promising, there are potentially circumstances where we can live with tax assessed values, where we can do an actual, like a property and evaluation. In some cases, we can do a broker opinion letter, but it's a case-by-case basis. Typically, we do an appraisal, and the property typically, if it's a $500,000, you're probably talking about an investment property, a 1 to 4 family maybe, and those appraisals are really only about $700, $500 to $700, $500 to $800 typically. So those cases, we'd usually ask for the appraisal to be done in lieu of one of those other things. We do have certain circumstances where it might not be required, but typically it is. And then the question about nationwide, our typical rule is look, see, feel, touch. If I can look, see, feel, and touch it, I can lend to it. If you are a borrower member in New England, by case basis, no guarantees, I could potentially lend somewhere else, but typically it should be within my normal New England geographical locations, and or down by, like, let's say my the branches down in DC. Potentially I can lend to you as well around DC, as long as it's, within reason near my branches. So that's a case by case basis. But if you told me I've got a huge development in Florida or Texas and you don't actually live in my area, et cetera, I probably can't do it. And it'll depend upon the size and what is required for me to be able to say, okay, the property is still in good condition, et cetera, for me to be able to visit it. If you want to do a loan in the Cayman Islands or Aruba, maybe I convince my boss that they'll create a vacation trip for me to check the property. Typically, I don't get away with that. So that's just to answer that question. But as far as what I like to say is, if you're a first-time real estate investor, what I would say is call us, talk to us, start a conversation so that we just really get into what is your appetite? What are your thoughts and concerns? What cash do you have? What are we looking at? Are you going to liquidate retirement to do this, or are you going to just use cash on hand? Are you switching an investment? I like to talk through your scenario first to understand, and then I send you on the side of the road to one of these properties, and I say, here's the cash flow sheet. Do a couple flybys. Do a hypothetical. Boom, boom, boom. Fill out the sheet. Oh, that makes sense. Or nope, it doesn't make sense. The more you do it, the quicker and easier it will be for you to do it in the future when you really want to pull the trigger. And then when you actually have the cash, like if I tell you how much cash you're going to need, it creates a budget of how much money you got to save. If I have you doing examples of properties to try to look at to do as examples, it'll get easier and easier. And you can just look at a property and be like, nope, doesn't make sense. I mean, and a lot of times I'll look at stuff. Some investors don't care where they buy. I try to look at it. Where would I want my daughter to be renting, and would she be allowed in that house or not? So there are different mentalities and thoughts about it. People can make a lot of money in bad neighborhoods and bad areas, but I like to look at, is it a good investment for the right reasons? I had a conversation the other day with someone. We were talking about college and how kids get kicked off by, let's say, junior year, and there's potentials to buy condos, houses, et cetera, that you can put your kid in. But then at that point, decent neighborhood that you pick, that your kid goes in, you're the landlord, you control it. So there's a lot of pluses and minuses to that. I think there's an article in one of our blogs that the marketing department did that talked about like buying a condo for your kids' college. And I've had people do it. One guy bought a condo in Boston. At the time, it was crazy money, $700,000, I think, or $600,000, whatever it was. But he put 3 kids through Northeastern in that condo, and by the time he was done, it was worth $1.5 million, $1.7 million. And it was just a great way to do it because it actually supplemented, instead of paying room and board at the college, he did it through his own condo and he got the equity at the back end. So there are circumstances like that. There's a lot of stuff now around colleges where they're renting by the bed. So you can actually have a house and you rent it by the bed. So there's a limit. I think it's 6 kids in the house or whatever it is, but you basically get paid per bed by each kid. And the property, what should be worth $800,000 could be worth literally $1 million as an investment because of the return you're getting renting it as a bed. And it's location, close to a T, close to a college, things like that. There's a lot of parameters that you want to think about. And if you want to buy a property and say, hey, for $30,000, $50,000, I could renovate this thing and go from $800 in rent to $1,600 in rent or more, those are all it's strategies. It's thinking about how would you do it. So every one of those is a case-by-case basis. So I always say, let's just talk it through, talk about it. If you have investment properties now and you already know it, we'd love to, have you consider us to do your financing. We will refinance other places. We can do new financing for you. And at the end of the day, it's really who you guys are comfortable with. Who do you feel comfortable with borrowing money? Because at the end of the day, if there was a problem, God forbid, you'd like to have a normal person in front of you. I had one person that saw something online, put something into their application and went talking to him. Well, they did a hard pull on his credit, which screwed up his credit. They don't know anything about him. They lied to him 3 times. So it's and I said, you know what? You went playing, looking, you didn't know them, and you got what you asked for. So those are all things that at the end of the day, where you're comfortable, where you're happy, that's how I usually tell people to borrow. If there's a better deal for you and you want to be someplace else, go ahead, that's fine. But we like to be with you as a partner, not just as a transaction, but that's just us. I think that was sort of a long-winded overview of those things. I'm sure there'll be more questions. Reference sites, mrlandlord.com. This is one I throw to people. It's supposedly it's one of the oldest online .com landlord websites. It's actually pretty slick. It's got things out there for all the different forms that you would need, be it leases and agreements and stuff like that. It's also got forums that they post out there. Once you join it, people come up with a problem, and then the people that are experienced tell them how they solved their problem when that happened to them. They'll give them advice. There's all sorts of different resources out there. So that's just one that's kind of fun to just surf around and look. The local area real estate associations that I mentioned, if you type in your area where you live, you can find these places. They'll usually show up like Boston Real Estate Investment Association, might be Dorchester, could be by you. Sometimes it's by town, sometimes it's by region. But these things, like this example I threw in there, reiclub.com, bostonarea.com, all of these places have these types of groups around. And there have been ones that have like a housing court judge is in this group. So the person comes in with a problem and they say, geez, judge, what would be my defense or my problem with X? And they'll tell them, well, I'd kick you out of my court, or you'd be in pretty big trouble, or whatever. Great resources, insurance, people buying properties, what they've negotiated. It's a good resource, all of those people that you may be in contact with. As I say in my thing, there are no stupid questions. The next slide, Michelle, there's no stupid questions. So I don't care what your question is. There is no stupid question. If you know what you're doing, I'm still learning 30 years into this thing, 30 something, whatever I am now. I learn every day something new and different. It fascinates me. Billy says I've never been stumped. I may not have been stumped, but I get questions sometimes, and then I find an answer, and then I say, wow, I never knew that. I mean, just bizarre stuff that I would come up with that I never would have thought twice about. If you're just thinking about it down the road, ask questions now, learn the basics, just keep gaining knowledge, and then down the road, maybe the time you buy. Don't buy before it's your good time, because if you make a mistake, it's costly. But if you just say, okay, hypothetically, I'm going to look at this, I'm going to do this. If you take a property, say, pretend I bought it. Then look at the market. Did the price go up? Is it worth more money now, or did it go down? What are the rents in the market? Did they go up or go down? Would it have been a good deal for me? You can just like do hypotheticals. It's a great experience. It's a great exercise. And analyzing the cash flow, using that cash flow sheet I mentioned. Every time you just look at it, just keep doing it. Keep doing the hypothetical, do a property. Yep, makes sense. Nope, wouldn't make sense. And then the more you do it, the more you'll learn. I think the biggest thing is if you know somebody that has properties, just pick their brain, figure out how they have the properties managed, what they do. Some people do a la carte management companies, meaning they have a handy person that just oversees the property. I just talked to a guy yesterday. He moved down to Florida. He has a handyman that babysits his properties that are all around up here, Worcester, Leominster, Gardner, et cetera. So he just sends the handyman to fix the problems, as opposed to a management company that would cost, let's say, 8%, 10% of your gross rents. He just pays this person on the side as a salaried or whatever they do for, having them in place, but it's cost them maybe 2%. So it's a case by case basis. So those are just things to keep in mind. So just ideas. And then again, we have the contact, I think, at the end again. So these are all, you've got emails, telephone numbers, et cetera. Michelle and I are always willing to talk, listen, learn. Either one of us, I sadly will probably respond. I'll be sitting at the soccer game, I'll still respond. And Michelle will do the same thing. It'll be a weird time at night, and all of a sudden you get the email, she'll respond as well. But I'm not guaranteeing that, but I'm just offering you may get the call. If you call on a Saturday, you actually get an answer. So.
Right.
So that's the gist. So now let me go back and see if I see any more questions.
There's two more, Phil, there's two more in the chat. One was from Raymond. He said, how much of reserves hiccup do you require?
Yeah, I guess I would say to you on that one, Raymond, I would say if it was you buying this property today, so you put your 20 in for your down payment, you've got your money to close the loan, stare at the house and say, how much in my mind would, let's even go crazy land, a new roof or a repaired roof or the heat system. Like when you do the inspection will point out a lot of the stuff. If they tell you it's got 1 or 2 years left, then at that point, obviously we got a red flag saying, okay, we're going to have to fix this thing within 1 or 2 years. So how much am I going to need to budget either now or quickly over that 1 or 2 years through rents, excess cash flow, et cetera? So how much, I do not have a set driven number, but I would sit there and say, okay, for you to be comfortable going to sleep every night, what do you have? Can you borrow against your 401k as a 401k loan in an emergency? Do you have extra cash sitting somewhere in a savings account? Do you have stocks and bonds? Whatever. Access to cash. Do you have friends, relatives, et cetera, that might be a resource to cash in an emergency? A lot of times I'll just talk you through that. It's not a requirement per se, but it's more just a thing we look at to make sure when we're talking, because I don't want you to fail in this scenario. I don't want to pass due on my report any more than you want to lose a property. So that would be the answer to that. Please share the recorded PPT and PDF you're presenting. Thanks. All right. So at some point, that's a Billy thing. Billy or whomever, I'm not sure how you're doing this, Bill, for a recording version.
So we've had a lot of requests for the recording today, Phil. So as soon as this is done, it'll send me a copy of it. I have to edit it a little bit and then put it up to YouTube. So give me a day or two and I will get the recording out to you. We've also been asked for a copy of the slides, and I will send a PDF version of the slides to you as well in that email. I'm going to send it to all participants because I have not been able to keep up with who wants it and who doesn't. So if it's something you don't want, just delete my email. It'll come from me.
Yeah, we had
And I
another
see
question.
David-
Did you see David's question?
Yeah, and this goes to my ebook, David. It depends, because there's a lot of different components to that question. You gave me a completed application, so that means I got everything: tax returns, all the application forms are signed and done. And what happens is you submit the application, we go through it, we look for any deficiencies in it, signatures missing or whatever. Once it's absolutely completed, it gets put into underwriting. They are a little bit backed up, but they're not usually the stall point. The stall point is usually the appraisal, which again, could be 3 weeks, it could be 7 weeks. So that can create issues. The attorneys, as long as title is clean, that's usually within a week or two, a couple weeks, whatever. So a lot of it, and again, case by case, if everything on the title is clean, fantastic. If we find bizarre stuff there, liens or problems or deficiencies that whatever, that can delay things. If it's a already owned property, we know you have clean title, the appraisal is going to be quick and easy, then it can go very quickly. But it is a case by case basis. So, and what I try to do is you start with the P&S, and if somebody says, well, how long? I usually tell them in the P&S, ask for like 45 or 60 days as a beginning point, but find out for sure that there is in fact some leeway, God forbid. If I get the appraisal and it's just stalled, if that's the holdback, make sure that you have some capability to extend that P&S. So at that point, you don't lose your deposit. And then also your timing for the inspection, your timing for financing, you always want to do in that P&S. I forgot to mention that. In the P&S, you want to make sure you have a financing contingency as well. Because at the end of the day, if you get spooked and you don't want to do the property, and I'm the possible problem by saying you can have money or you don't, if you give me reasons why I should be scared, then I can be like, I'm not giving you the money. And then your financing contingency went out the door. Meaning I'm not giving you the financing, so then it's not, if you couldn't get it, you couldn't get it. That's just a hyper.
There's always the issues at the end, potentially with title. The seller could think everything's fine and everybody, thinks there's not going to be an issue, because nobody ever does think there's an issue with their title. But we have had situations where there were liens that were, never released and still recorded. So even if we give you an estimated amount of time, which we always do in the beginning, it's always subject to how long the appraisal is going to take, if there's any title issues. So we try and give you the information you need, but it's subject to a lot of stuff.
Yeah, like there have been circumstances where a loan was paid off a long time ago on the property, but the mortgage was never discharged.
Right.
And now you got to down that discharge. That can be a nuisance. But in general, we try to have open communication, so timeframes, et cetera. And if the P&S has a specific close date requirement, we try to work to that date. We'll try to find an appraiser that can maybe do a favor and get it done by a certain date. We'll tell the attorney this is the time frame we have. We have some that are quicker than others. So we would find the quicker one if it's quicker, or if the other, if it's a cheaper price, but it's going to take longer, that'll be your choice.
Yep.
So I don't know if there's anybody specifically with questions. I guess I leave it open. You're welcome to call after this, email after this at any time with whatever questions may arise. But if there's anybody else specifically here right now that has a question, feel free to throw it out there.
You can, or you can unmute yourself and ask real quick while we wrap up here. I will say that some people just say, yeah, call me. Phil and Michelle mean it, and they will call you back. Very, very responsive on that. Oh, question just popped in for you, Phil. Today's rates, question mark.
Today's rates, give or take. Again, this is today because it's changing on a momentarily basis. It was about, I think I mentioned before, 4.375 hypothetically for like a 5-year fix. So that's 5-year with a 20-year in, so give or take about that number, 4.375. And then for 10 years fixed right now, hypothetically, it's right around 4.65, 4.75 today. But every day I wake up, it's an adventure to go to the Federal Home Loan Bank and see what they've done to my rates. So
It's
someday I could be
changing
talking
daily.
to you. Yeah, and it's what we try to do is when we basically commit to you or basically negotiate something at that time, we try to hold the rate that was there at that time. We try not to do a bait and switch. I don't want to be saying, hey, we based everything on 4.5%, and now all of a sudden, hey, it's 2 days later, well, now I'm charging you 5% or 4.75. I'm going to try to hold at that rate that we basically agreed and committed to. That's not normal. Some places would definitely say day of close, the day of the rate you get. So we try to be fair because I've done the underwriting based upon that rate. The 10 years fixed, it's a partnership. What I said is what I meant, and that's what we try to do. There could be an exception to that rule, but 9 times out of 10, that is our rule.
That'd be hard to plan if you didn't know your rate.
Well, and that's sort of the thing. I had somebody call today and they were panicking because they thought their world was imploding, and I'm like, I'm out. I got it approved. I have a commitment letter coming to you today or tomorrow. I held you at that rate. I'm not like residential where we can actually fix, like give you a rate lock at a certain, we don't run like they do because they're talking about a secondary market, et cetera. Mine is we hold our loans ourselves. We do not sell our commercial loans. We hold them in our portfolio. So it's driven by us. So as long as I'm making what I need to make, cost of funds, et cetera, for me, for the credit union, then that's what we're doing. But we try to be fair. I've got people that we negotiated and committed in December. Sadly for you, they got much better rates because back then the rates were much better. Today they going up and it is what it is. But everybody realizes that. I've got people trying to refinance portfolios of their stuff right now because they're trying to get as close to the current rate as they can before it keeps going up, which they claim it's going to keep going up. So.
Very good information today. Thank you, Phil and Michelle. A lot of great questions. I will be in touch with everybody by email as soon as I can. I'm thinking in my head, I was hopefully tomorrow, but if not, it'll be next Tuesday, but I will definitely get back to you. In the meantime, don't hesitate to reach out to Phil or Michelle with any other questions you have. And I'm excited for all of you on your journey to be investment property owners. So anything we can do to help, don't hesitate to call. Thank you so much for attending today and have a good afternoon.
Thank you, everyone.
Thank you. Bye-bye.